I'm just going to very briefly introduce you to the panel. Luc Falempin to my left, who is CEO of Tokeny, Sabrina Wilson, who's COO of Copper, Yuval, who is COO of Digital Asset, and Caroline Malcolm, who is Head of International Public Policy and Research at Chainalysis. We're very tight for time, so I'm going to get straight into the first question, which I'm going to ask Yuval and Luc to address. The key to realising the potential of DLT in financial markets is moving beyond crypto to the tokenization of securities. Just how does tokenization of assets deliver a solution which is quicker, cheaper, better, and safer? And how does it address shortfalls in current financial markets infrastructure? Well, do you want to?
Sure. I think that what crypto has shown and crypto-related assets is that when you have assets that are fully digital, meaning from the moment of creation through programmability of lifecycle events, or what are the rights and obligations of the different stakeholders, you could do a lot of things much quicker and much more efficiently. We talk about DeFi, for example. I think what people don't have an appreciation is when you start thinking about traditional financial assets, so you can see some faces here that have come from that industry, including on this panel, is when you start thinking about bonds, structured products, and other loans, very complex assets, you have quite a lot of stakeholders. And today, the way that these assets are being managed are in silos. So the industry pays hundreds of billions of dollars in reconciliation and management of that data. So I think that the opportunity that is inspired from this technology in crypto is if we can start issuing assets in a fully digital manner where all the stakeholders are connected to this source of truth. First of all, you can eliminate reconciliation. That's step number one. But I actually think that the opportunity is to be able to connect markets on a new rails that is much more efficient. So today, when you issue a bond, your custodian finally will get their hands on that bond. But then if someone wants to repo or use that as collateral, that takes a long time. I think that with what we are creating in this industry, you will come to a day where a bond can be issued as a fully digital asset, and the next day someone can use it as collateral or repo it to get financing.
Luc, do you want to add anything?
It's hard to do opposite, but I totally agree with Yuval with those arguments for sure. I think we see blockchain as a shared IT infrastructure. That's why we really like working on public blockchains, because for many financial instruments you don't have any infrastructure. Public markets, okay, you have infrastructure, you have exchanges, large players, and intermediaries working. For private markets, everything is paper-based, and sometimes with faxes. We're still there. So the whole back office is still very analog, and we see blockchain as a shared infrastructure that everybody can use, connect directly to this infrastructure, and transfer value. So indeed, it reduces a lot data reconciliation of identity data, asset data, and transfers all of the information that you need to operate. It's really, for us, it's really a new internet of value. Today, the banking system uses the internet that we know where you transfer information. So basically, you need to tell someone else, I verify this information, I did these operations. With blockchain, you do it because you can transfer value and you can program these assets with smart contracts. So it's a natural evolution.
So faster, better, cheaper is a realistic ambition.
Yes, if you eliminate or reduce the things, data reconciliation, and if everybody can use the same source of truth, you definitely make it cheaper.
Yeah, I'll just take one quick example because there's a lot to discuss. Deutsche Börse last year just launched a new CSD to issue new digital assets and traditional financial instruments. And the product they started with is retail structured products, which would have taken usually 3 to 6 days to issue. and now it takes them under 10 minutes to issue these assets. So you're already seeing things that are happening. It's not just like dreaming.
Okay, so the technology is there, or at least it's emerging. What do we need to see happen in the regulatory and policy space in order to facilitate the uptake of this kind of technology across the financial services sector more widely than the leap from crypto to traditional financial assets? A good question. Anybody got a thought on that question?
Yes, look, I think that there are some fairly significant differences in the underlying technology when we talk about DLT-based infrastructure. And part of, I think, if you think about the sort of infrastructure in the way Yuval's described it, the sort of data piece is sort of necessary, so necessary complement to the sort of underlying infrastructure. And it's necessary, I think, in sort of three ways. And the first way is really in sort of regulatory and policy space. So building the confidence in the policymaker and regulator community is a space that they can understand, and with that they can feel confident in creating a regulatory environment which is really necessary to bring confidence from institutional investors to start really playing and making that shift from traditional infrastructure into DLT-based infrastructure. So I think it's really important in that regard, and equally for them, sort of data piece and understanding and really sort of seeing what's possible in terms of transparency, and to pick up on some of that, really will help build that confidence that will allow the investment and have that kind of transition to take place. And then I think the sort of third piece is in the sort of ongoing sort of monitoring, again, from both the public and private sector perspective, being able to use that sort of foundational transparency and immutability to really sort of have a much better picture in real time about what's going on. And so that will also make, I think, over time, the actual monitoring of this space far less sort of human intensive, and also allow people to really focus on sort of problem areas rather than just sort of work day-to-day monitoring.
One extra thought, if I may, typically the regulators regulate the utility rather than regulating the technology. So I think we are seeing here, we are seeing here the adoption of a new tech, so obviously everybody is focused on the technology, but the technology is here at the service of the utility. So when you get into a more mature regulatory framework, I think the technology will take a second backseat initially, as we talked about, but in the future it will be much more activity-based, with that a new transaction versus liquidity provision versus the back-end custody clearing, etc. So that's an important evolution. And the last point as well that you and I have spoken about in the past is equivalence. For us to have a very good 24-hour setup with regards to a good regulatory framework, it needs to be equivalent. And with that, it means that all the countries need to come together and really sort of self-certify that their standards and their respective standards are equivalent, and that they are allowing the market to operate truly globally in 24 hours.
And I think that it's a really good point, because without that, you're not going to be sort of realising the benefits of making that transition. So in fact, the sort of policy and regulatory pieces should be sort of really considered quite key. If you think about infrastructure, that's separate. In fact, to actually realise all those benefits, you need to have that sort of fully implemented framework.
I think maybe something to add is that I think that there's, in most countries today, sufficient regulation that actually allow already digital assets to exist. And I think that this is maybe one area where I think the industry could do better, is rather than to say we're special, we need to have special rules. I mean, we have clients that are heavily regulated that are processing in the hundreds of billions of dollars of transactions every single day. And they got approvals from regulators. And I think that the reason is that they went and said, we understand the regulation, we understand what you're concerned about, but Marion, together with what Caroline said, is actually saying, by the way, look, we can actually give you the transparency and all of the things that you care about if it's in order to do your job and to feel comfortable that we're not really going to risk our clients' funds. I think that if we do that more often, I think that we will be able to bring regulators along the journey.
So perhaps the challenge is to convince regulators that the existing regulatory framework is actually sufficient to regulate most digital activity.
In many cases, yes.
I think in most countries it's the case already. You can already tokenize securities because recognize that security tokens are securities. However, the rules for the secondary market are not clear enough or suitable enough, and also for stablecoins, because the status of stablecoins is still ongoing.
We might come back to stablecoins in a minute. Let me move on. It's probably an understatement to say that over the last few weeks, months perhaps, there's been a lot of focus on counterparty risk around crypto asset trading and settlement. Sabrina, how does the offer of digital asset custodians differ from the custody model for traditional securities?
A lot of differences. I think there's one of the problems which is when we talk about digital assets and it's going to evolve into the securities playbook, which will make those two concepts converge. But for now, what we are seeing in digital markets is essentially cryptocurrencies, some stable coins, we'll come back to that. So there's one of quantum. The first very big difference is 800 billion of assets versus 120 trillion in custody and in equities alone. So you can see already that with that comes the factor of the institutions that don't participate in traditional custody are deemed for the most part to be globally systematically important institutions, GC in short, and there are very, very few of them in foreign reason. They are a point of trust, they are a point of accountability of sorts, and with that comes the fact that they are highly regulated and also constrained in the type of activities they can take. So the big difference between what we see in crypto and what we see in traditional playbook is the unbundling of that market structure. When you are a custodian, you are here to secure the asset, you are here to service the asset, and all of the activities that you do around execution, fund administration are at the service of the assets. Whereas in the crypto markets, you see a lot of bundling, hence your point on counterparty credit risk, between liquidity provision, trading, market making, custody in one single market structure. So that's a big, big point. I would say as well, and you've touched on this, both of you, with regards to efficiency, traditional custodians are not exactly the most efficient from an operational perspective. Most of the challenge of the TradFi custodians is actually an operational challenge. Digital asset custody is more of a security challenge. So you get very fundamental, not only challenge in terms of how you run that business, but also the shape of the folks that you need in that business. So the people transformation is something we don't talk about enough, but I think it's a very important one for adoption as well. So we don't have the time to explore all of this, but we could literally spend just the whole time on those differences and they're not so subtle.
Would it be fair perhaps to say that this, what you call bundling, is going to be an area of sharp focus for regulators and policymakers in the wake of the events of the last couple of months?
I think one thing to add, which all the points were really good, but I think that there's also, we need to also make another distinction that in the case of crypto custody, your counterparty risk is technology counterparty risk, which is kind of what you're alluding to, where if you are custodying treasuries with BNY Mellon, right, you don't have counterparty risk that if they lose their keys to $17 trillion of treasuries, those treasuries are gone, right? So I think we need to understand the distinction that crypto is a bearer instrument where traditional financial assets are not bearer instruments. So you don't have that type of counterparty risk in the traditional world, and that creates, the technology challenges that companies like Copper, for example, are solving.
And as these are tokenized traditional assets, how does that equation change?
I think that that's the part that people are having the challenge of accepting, because I can tell you, working with a bunch of buy-side firms, they will not tokenize trillions of dollars and be willing to take that technology counterparty risk, because we all know mistakes happen. I mean, mistakes that are the smallest, tiniest human error. I was a high-frequency trader, a 26-year-old at night trading, uploaded the wrong version, and the company went bankrupt in literally 40 minutes. So to me, you will never be able to take those type of
I see that on your CV.
not being when I was trading, there was no guy. And my point is that the tiniest mistakes
We just got out last week.
the tiniest mistakes could lead for bad outcomes. And I think that big firms that sit on massive amount of assets that do want to tokenize, do want to gain the efficiencies that myself and Luc talk about, will have to adjust to take some technology risk, but not similar to crypto, which has a different proposition of saying if my keys are lost.
In the meantime, the industry's got to think about how it can shrink that technology risk to make it more acceptable.
It's actually one point, a very quick point I will make. You can see the playbook developing in Europe, in particular in MiCA, where the custodian is actually held responsible in draft for not only securing the key, but also what's happening to the assets on the chain, which is really different to what we look at today, which is really the security of that private key, which is key. It extends the role of the custodian. So you can already see that the technology risk is something that we are watching very carefully.
Yeah, okay. And I think at the same time, you've seen recently the Basel Committee on Banking Supervision in their work on traditional financial institutions' exposure to the digital asset industry have taken a step back. There was an idea at one point in their consultations of having this sort of technology infrastructure sort of loading that would be an extra cost of capital to businesses participating in this space. There has been a step back from that because I think also there's a recognition that while there are some specific risks that we see with this technology, there's other areas where this technology takes risk off the table as well. So it's not apples for apples, and so we do have to think about them a little bit differently, but there's areas where we are sort of safer in this space than we are perhaps in the traditional financial space.
Okay, I want to move on now to the great public-private debate, and this is going to be a question aimed at you initially, Caroline. The public blockchains contain a lot of information for those who know how to find it, and obviously that's why this question comes to you. You're a person who knows how to find it. And transparency has an important role in marketplaces, but at the same time, market actors don't always welcome perfect transparency around their activities and things that are signalling their intentions. So how do we resolve this tension? Will the desire for privacy lead to an increase in the use of permissioned blockchains, do you think?
Look, I think that is a sort of a natural tension, but it's very difficult to see a lot of the benefits of making the transition to DLT-based infrastructure come to life if you moved into a permission system. So I think then the challenge is, working within that sort of permissionless space, how do we make that? How do we kind of balance out those things rather than sort of a debate about permission versus permissionless? It's really about, within the permissionless space, how do we achieve some of those, that balance between transparency and also the desire to sort of not have exposure of all of that information. I think we are starting to see quite a lot of technology still being built, and I often say with this space, we're already sort of 13, 14 years old, and at the same time we're only 13 or 14 years old. So there's a lot of things that is still yet to be built in this space, and some of them are around these sort of privacy enhancing tools, not in the sense of sort of privacy tokens that we're which sort of take a lot of the headlines, but really in that sort of infrastructure layer, using sort of zero knowledge proofs and so forth to really find that right balance, which will give institutional players in particular the confidence to come into that space.
Okay.
Yeah, I think I'm totally in agreement with Caroline. I mean, if you think about public markets in the world today, you do have something like the tape, where you could see market activity, but you don't necessarily see who are the participants that have generated that activity. And I think what you're going to see is permissionless chains that are going to be on the cutting edge of technology will say, well, not everything needs to be public by default, and you should be able to have this ability of trustless infrastructure, but that you as the application provider can decide what is your privacy model. No different than on the internet. You could have a website where you need credentials to log in, and there are websites that are fully open. I think you will see permissionless chains move in that direction.
Presumably the purists will hate the idea that you can artificially introduce obscurity rather than transparency.
I agree, but I think the nuance there needs to be the purists with specific asset classes. So I think that Bitcoin has a specific structure and a specific mechanism built into it, that it should stay the way it is because it's solving a specific problem. I think what we're talking about is an infrastructure that should be able to service multiple applications that have different utilities.
Yeah.
Right? So I'm not trying to challenge the purist that says Bitcoin should remain the way it is. I actually agree. But we're talking about infrastructures that need to serve multiple different applications.
Yeah. Anybody in the audience got a question they want to ask? Yeah, gentleman here.
So I built, excuse me, my team built, just going to turn the mic on. Try number 3, all right. My team built one of the largest privacy protecting blockchains in the world. We're installed in about 100 million devices at this point. We recently announced that we have forensics coverage with Elliptic, and I think the compromise of like having privacy and also forensics is not only possible but desirable. The question I have is, which network that is used at scale for payments or monetary transactions does not have privacy?
In the traditional finance.
Stock market, ACH, wire, which one doesn't have privacy? I don't think there's any of them, right?
No. The tapes started, I mean, equities, if you go back far enough, even at the very beginning of electronic trading, was all open. So the tape, anonymous tape, is actually a 15-year event.
Open for people at the field of the tape,
Yeah.
not for the world.
No. Everybody should be able to see the tape. It's a public infrastructure by definition.
I think at the beginning of the equities market, not everybody had a tape feed, and they certainly didn't have a way to publish it where everybody in the world could see it.
Quotes tend to be much more open. The tape tends to be anonymous, pretty much, because you have to take counterparty credit risk, so you have to know who you're trading
But
against.
I think everybody's saying the same thing, is that, and again, move away from Bitcoin, which is a use case. It's an asset class by itself. I think what people are saying is the permissionless networks should move in a direction that allows for privacy. From my perspective, imagine that Bitcoin did not exist. That permissionless network should allow to run a use case like Bitcoin on it that doesn't require, well, pseudo-anonymity, but doesn't require privacy. So to me, the goal is to have an infrastructure that can support, like that's why I came with that example of the internet. The internet allows you to build websites that have no privacy, but it's you as the website creator that needs to decide what do you want for your use case. Or if you want to run a regulated bank, well, guess what? You need credentials that are given to you only after you get KYC AML.
Okay. For DeFi market infrastructure to run optimally, we need stablecoins or CBDC to be formally established for settling and clearing of trades on the blockchain. And secondly, we need some kind of infrastructure to establish identity that will help institutions to comply with their KYC and AML obligations. Yuval, on stablecoins, do you want to just tell us where we are and where we're going?
Yes.
And then maybe Luc and Caroline, you comment
first of all,
on identity.
I would say that in order to achieve the efficiency of this technology, whether we call it DeFi or whatever we want to call it, I do agree having, and in my definition, it would be cash on ledger. And I'm keeping it like that because to me, cash on ledger could take many forms. I mean, today everybody's talking about stable coins and CBDC, which are fully collateralized assets, but anyone who works in financial services know that that world economy runs on liabilities and actually not on fully collateralized assets. So to me, being able to bring the payment mechanism on chain is critical. Stable coins were the frontier, and we're seeing, algo stable coins, which to me is a bit of a joke. But you're seeing now people are starting to pay attention, and you're seeing regulators starting to pay a lot of attention, and we're starting to see regulators starting to ask, well, if you call yourself money and your money gets used by bad actors, what do you do about it? So I think stable coins are starting to get quite a lot of attention, which is a good thing. It's not a bad thing. CBDCs, we are working with 3 or 4 central banks at the G20 to do that. So you're seeing pretty much every major central bank today either about to release a CBDC or is in advanced experiments. And you're also seeing the next innovation, which is to me actually showing running liabilities on chain as a way to settle transactions. Now, liabilities have counterparty risk, but it is a way to settle transactions on chain atomically against another instrument.
Caroline, do you want to say something about the identity challenge?
Yeah, so I think, I guess the identity piece, we're still very much in this space focused on sort of traditional KYC, and I think that as you particularly move into DeFi becomes sort of a little bit more difficult. And I think we're starting to see some different models about how you do identity and how you can sort of perhaps play in the sort of DeFi world with perhaps some different ideas. There's some, for example, around you sort of get KYC'd, and this is what sort of Singapore is talking about. You sort of get KYC'd in terms of being able to come into the sort of the DeFi playground, if you want to call it that, and then while you're in that playground you can do what you want, and then you get KYC'd again on your way out. There's some obviously interesting proposals in terms of having your identity token linked to particular wallets, and so then being able to control in a much more direct way how your identity is exposed in different transactions and so forth. So I think it's another area where we've seen a little bit of the technology, but probably not nearly as much as we'll need to see in terms of actually kind of growing out this space and making it more feasible from both like a regulatory perspective, because I think there is a lot of attention, and particularly around stablecoins, there's a huge amount of sensitivity around the growth of stablecoins in the market, and also making that an attractive proposition also for traditional finance. At the moment there's the rules, particularly the latest BCBS guidance, don't necessarily make it as attractive as it might be for a TradFi to enter into the stablecoin space. But that's sort of what we really need to get to this point, because really, tokenized assets are great, but in terms of really, again, realizing the full efficiencies, you need the payment rail to go alongside the asset. Keeping them separate is just not, you're going to get some of the efficiency, but not nearly as much as you might. So you need to have that trusted money that can move alongside the asset itself.
A lot of nodding going on there. Everybody's in agreement with that. Luc,
definitely agree for stablecoins. If the cash leg is not on chain, on the same ledger, most operations cannot be automated. Basically, your securities will travel very fast, and your cash will still be slow, so everything will be stuck, and you will need to wait anyway. And that's why we help more and more financial institutions to tokenize cash, different forms, sometimes e-money, sometimes the different type of regulations and different way to do it, but it's very important, and we do it in a permissioned way. So today the stablecoins on the market, like USDC and others, are permissionless, meaning you can send them to anyone you want. So in terms of compliance, I'm not too sure it's going to fly a very long time, but so you can send them everywhere, and if you lose your wallet for some reason, or if you get hacked, you just lose your money. So it's very complicated. I guess it's good for copper. But for many who don't know even what is a wallet, it's an issue. So we create permission tokens. So basically you have a centralized issuer who can control these tokens at any moment. And how do we permission these tokens on the public blockchains? We do it with identities. That's why I'm very happy we talk about identity today, because for 5 years we say we need to identify properly each stakeholder on the blockchain. If you cannot identify them properly, you cannot apply any rules, any permissions. So that's why we created this on-chain identity system. And actually, when you hold security tokens, we don't really care in which wallet they are, because your wallet is linked to your identity, which is great for privacy as well, because you can theoretically change your wallet address anytime you want, and you can still prove that you are the owner of these assets on the blockchain. So identity is really, really key. Hopefully in Web3 it will be self-sovereign identities and not Google identities. But there are solutions for this already. We just need a bit more adoption. And I think it will come by tokenizing real world assets, because you need this level of compliance and control, especially for DeFi. So we are based in Luxembourg. The regulator in Luxembourg loves DeFi. but for the moment, they don't want you to do DeFi. Why? Because they don't want you to interact, even indirectly via smart contracts, with everybody in the world, with retail investors, with people in North Korea, and so on and so forth. But if you can permission the blockchain protocols with identities, so basically you filter your participants depending on your criteria, it changes the whole thing.
So it's an enabler, essentially, for regulators to be able to engage a bit more.
Yes, because with identities, you can prove that you are the right owner of this digital asset.
Yeah.
Because a wallet address is not an identity.
So to come back to the hacking theme, which you mentioned, Sabrina, underneath all this trading settlement, crucially, assets have to be kept safe.
Yeah.
And the sector has proven itself to be somewhat susceptible to hacking. How are institutions, investors, asset managers going to be reassured about the safety and security of their assets?
So there's obviously the physical security aspect, and I know we had a lot of conversations around key management. Is it the best way on a going forward basis to have hundreds of trillions of dollars on chain? That could present some problems, and I'm sure, like any problem statement, solutions derive from that. So if you have a crystal ball, what we do today in terms of key management, is it going to be the best solution ever for the future? Probably not. Will we find a way to have a much more federated model in order to do this also in a more practical way when you increase the number of transactions, etc.? So I can see an evolution probably, without having a perfect crystal ball, but this is one area where it will absolutely evolve. With regards to security, you also have the security in a non-technical sense, which is your counterparty credit risk. So you're seeing on all of the screens here the strong advertising of Clearloop, which is another form of security, where you remove your counterparty credit risk, you sweep it away from exchanges today, and I'm talking really crypto, but all of these concepts already exist in the traditional finance playbook, where a lot of custodians actually run the collateral management business adjacent to their custody. And it's not a complete coincidence, it's because it is a huge part of it. And one point that we haven't spoken about at all today in terms of efficiency is the deferred settlement that we see today in the traditional finance playbook. What do you do when you have deferred settlement? You trap collateral. And the trapped collateral is typically a function of the volatility of the asset and also the time that you spend to settle those assets. If you bring this back to a more instant, the benefit of freeing capital from the system is also a huge deal. And this is why we're seeing a lot of the financial institutions really focused on this, not for the beauty of tech. They may have a bet that the tech is actually more efficient and better, but it's not just a solution looking for a problem. The real problem is the amount of trapped collateral there is in the system. And when you talk to the large CSDs in Europe, they literally have trillions of assets sitting there. Some of it have to be kept for the purpose of collateralization rather than creating liabilities. But also there's a lot of capital inefficiencies, and we shouldn't forget that. And that technology really untaps that.
Yeah, I think the stat is that 25% of what you would call eligible collateral is only used. So effectively,
for sure.
only you could effectively triple what you would do today to get to the 100% efficiency of collateral. And in economic times like this, and activity like this, the implications to the financial system are insane.
Yeah, significant.
Well, if I can add something, for tokenized securities, the security aspect is not really to keep the assets safe on the blockchain, because anyway you have a centralized issuer and authorized agents who can perform operations at any moment. You can recover your assets even. So the security aspect is not really there. It's more on the governance side, is to make sure that when you sign a smart contract operation, the right people are authorized to sign it, because it's a decision. If you mint new shares of a fund, for example, it's a legal act to create new securities. So you need to make sure that the governance and the rules, the policies are enforced properly, and nobody can take your identity and access to your wallets and do this on your behalf.
Yeah. Any other questions from the audience? Anybody got a burning question they want to ask any of the panel?
In the back.
Yeah. Okay.
Yes,
Thank you. I've heard a lot of centralized issuer, permissioned access, regulators saying this and that, but Bitcoin and crypto was initially created for the aspects of censorship resistance, self-sovereignty, and other aspects. So my question is, I guess, how do you see the future of those cryptocurrencies that do adhere to these principles vis-a-vis the institutions, and especially vis-a-vis the countries? Because we do see some countries like El Salvador or Central African Republic who are trying to adopt Bitcoin, and then there are others who are saying, well, Bitcoin can be just regulated down to zero. So what do you think would be the result if some countries just outright banned these cryptocurrencies that do not want to kind of adhere to regulations? Do you see sort of a game theory where other countries will start and step in and make Bitcoin more welcomed? Or do you actually see the possibility for countries to group together and actually say whoever does not bow to the regulators and the central authorities will be just made illegal? Thank you.
Who wants to have a go?
Yeah, I'm happy to take that one. I mean, the data is really, really clear when it comes to banning. It just doesn't work. It's just to give you an example, in the Middle East, North Africa region, the fastest growing adoption is in Egypt, a country with a ban. And that's just true across the board. China, went on and off with its ban, brought it back in 2021. 2022, it's back in our top 10 in terms of countries' level of adoption globally. So it's extremely difficult at a practical level for bans to be effective. But I guess also coming back to the first part of your question, I'm not sure that it's like an either-or situation. I think sort of Yuval was picking this up before. Different use cases, different classes of assets for different people. There are very different things that you will be doing with Bitcoin than you'll be doing with, tokenized securities or different, tokenized digital native assets, tokenized physical assets. These are very different things. So I'm not sure that, those who want to continue to use Bitcoin, that will continue to be a space, but it's sort of separate and adjacent to some of the other use cases we're going to see.
Yeah, totally. I mean, at the end of the day, Bitcoin doesn't have an issuer, doesn't have cash flows. The second you go into an instrument that has cash flows, you are relying on some entity to release these cash flows. I mean, every fixed income product, you are effectively giving money for future cash flows in the future. You have an issuer, you will have a centralized entity there. So back to my point is different use cases, as Caroline said, that will have different outcomes and different regulations, but I totally agree that at the end of the day, we don't see it only in cryptocurrencies, we see it in other activities in life. Banning usually creates opposite effect.
Yeah.
And here you have two aspects. You have the assets and you have the method. So we've talked a lot about the method, which is the underlying technology. Everybody sees the benefit outside of the cryptocurrencies, but investors love volatility, and cryptocurrencies are an asset of its class. You can see now that it's getting more and more correlated. There's a reason to traditional finance because the investors like that. They need to position it on the risk curve. They have found a way to risk it. They have found a way to price it. So there's a future for cryptocurrencies, and there's also a future for the method. And these are different things. It's not one or the other, it's both. At least in my opinion.
Okay, we're running out of time. I want to ask you a quick question around scale and interoperability of technologies. Quite a few pilots have run into the same roadblock, the challenge of scale, the challenge of interoperability. What potential solutions are we looking at? Are we heading towards a multi-chain world? Are the large development communities on public chains the best way forward or not? Yuval, Luc, that's probably a question for the two of you. Luc,
Yes, interoperability is one of the key words when we talk with financial institutions. We solve this by using public blockchains, EVM compatible, so anything with the Ethereum virtual machine, meaning 95% of the activity on blockchain. So we can tokenize on any of these blockchains. And now we also have the technology to switch from one blockchain to another in less than 5 minutes with the same smart contract address. So basically you just need to inform your token holders, your investors, that now it's not Polygon, it's Avalanche. So we are going in that direction because we use the technology stack that is used by a whole community, a whole ecosystem. Probably the future is about hybrid blockchains. You don't need to record everything on public blockchains. You can think an exchange, for example, maybe once a day they can make a record on the blockchain. They don't need to have every trade. But it is important to be interoperable, to use the same standards, so the same type of blockchains, EVM for example, and also the same standard for smart contracts. So that's why we try to open source everything we do at the smart contract level, so we can build an ecosystem on top of this with different service providers, exchanges, tools, etc.
Yuval.
Yeah, I think that interoperability gets mixed with what Luc called standard, and I think that interoperability to me is a technical solution, how you could actually bridge two technologies. I actually think that the more important thing is standards, because at the end of the day you could have the best interoperability technology, but if one entity defined a bond in one way and another one defined a bond in a different way, it doesn't matter that you have the technology to interoperate, because from a technology perspective they are completely different. So I agree with Luc. Open sourcing work is the best way. I believe that at the end of the day, as we see in corporations, things converge, and the winner becomes effectively the standard. So
I think that's
I don't think that interoperability will exist in the future. It's just that things will converge. So by definition, you will have interoperability.
But I think this is almost like one of the learnings from the sort of the internet era, which is that we didn't really think so much about whether you call it standards, interoperability, but that ability to perhaps people, for example, to shift data from one platform to another. And that came very, very late, but it means we have, a very, highly concentrated, in some areas of the internet, monopoly markets. And I think there will be some consolidation, but I think the view that there'll be sort of one chain to rule them all, I think that's kind of dying out. There'll be different chains, and hopefully with standardization that will also give people more choice about what they do. And also, different chains do have different features. There are reasons to be on one or the other, and that will allow those kind of opportunities and innovation to continue to grow.
Okay. Time for one very quick question. Sabrina, I want to ask you this. With their abilities to take control of assets, where do digital custodians sit within the future financial markets infrastructure? Are they banks? Are they clearing houses? Or are they something unique and different? Very quickly.
It's a very big question you asked. Crystal ball moment, I think, in terms of the convergence, and if we think that the method is going to prevail and most securities, be it any form of securities, end up being tokenized, there will be a natural convergence. And why do people go to custodians? They go to their custodian, it's a byproduct of what else they do. They go to banks for liquidity, they go to banks for credit provision, they go to banks for the liabilities that they take on and the counterparty risk that they take on. And therefore, because they see pricing, liquidity, value in facing those counterparties, they tend to also do a front-to-back arrangement and custody with them. So I can see a world where the method prevails, securities become much more tokenized. We have a lot more emphasis on not just tokenizing everything for the sake of it, but really looking for solutions to problems that do exist, such as collateral management, capital inefficiencies, operational inefficiencies. So I'm not one who thinks utopia will prevail and banks will disappear. I think you'll see a lot of convergence. It will take time because there's a human factor of adoption that is non-trivial. And pivoting people to operate a fully digital environment is actually a big task.
Well, thank God banks won't disappear, because otherwise who's going to pay for Davos?
Exactly.
Thank you very much, panelists. Nick, back to you. Where is he?
Thank you, everybody. I think we're good to go. Thanks, everybody, for joining. Please follow us at Copper HQ, and feel free to share any feedback on the session. Thank you very much.
Thank you.